All right, welcome to the Explainer. Today we're doing a full financial health checkup on FDFC Asset Management Company, putting it right under the microscope. And our guide for this is a really in-depth analysis from Web Cornucopia Finance.
Okay, let's just kick things off with a number that really makes you stop and think. 58.2%. That's HDFC AMC's operating profit margin. I mean, how on earth does a company turn more than half of its revenue into pure, straight-up operating profit? It's pretty incredible. So yeah, let's dive in and find out.
So here's how we're going to break this down. Think of it like a doctor's visit. First, we'll get to know our patient, HDFC. Then we'll check its vitals, the financials. After that, we'll figure out its core strengths, look at the long-term outlook, and wrap it all up with a final verdict.
All right, Section 1. Let's get to know our patient here. So what exactly is HDFC AMC? Well, to put it simply, they're one of the biggest players in India's asset management world. A real titan, you could say, in a country where the investment scene is just exploding.
And here's why they matter so much. Their positioning is just perfect. You've got this huge structural shift happening in India where people are moving their savings away from traditional things like gold and property and putting it into financial assets. And HDFC AMC, they're right there, perfectly placed to catch that massive wave.
Okay, time to check the vitals. Let's get into the numbers and see what the financial health of this company actually looks like. Is it as strong as it seems?
Wow. And right off the bat, the first vital sign is looking incredibly strong. 28.5%. That's their return on equity. So what does that actually mean? Well, for every 100 rupees investors put into the business, HDFC AMC spits out over 28 rupees in profit. That's just incredibly efficient. It tells you this is a seriously profitable machine.
And then you see this, zero. What's that about? That, my friends, is the company's debt. They have none. HDFC AMC is completely debt-free. Think about what that means. It gives them so much flexibility and makes them super stable, especially when the markets get choppy.
So this slide really lays out the two sides of the story. On one side, you've got this fortress of a balance sheet. I mean, no debt, tons of cash, super liquid. But there's always a but, right? The analysis is clear that there are things you got to monitor. Their revenue is directly tied to their assets under management, or AUM. In plain English, that's just the total amount of money they're managing. So if the stock market tanks, their revenue takes a hit. It's that simple.
Okay, so the numbers look fantastic, but what's the secret sauce here? What gives this company its staying power? We're talking about the things that build its competitive moat.
And the analysis lays out a really strong case. It's built on these 5 pillars. You've got their market leadership. They're at the top of the game. Then there's the HDFC brand itself, which is a name people in India just trust. It's a household name. And you back that up with a huge distribution network, a track record of smart investing, and a whole menu of products for basically anyone.
You put all that together, and you get what experts call a competitive moat. It's a great analogy, really. Think of a castle with a big ditch around it. It's a defense system. These are all advantages that are super hard for competitors to copy. And that moat protects their profits and their piece of the pie for the long haul.
All right, let's look at the long-term prognosis. We know the patient is healthy today, but what about tomorrow? What does the future look like? Let's check out the opportunities and the challenges that are coming down the pike.
And when you look at the future, it's really a story of tailwinds and headwinds. The good stuff, you've got more and more people investing, the whole SIP culture is booming, and everyone's going digital. Those are huge pushes forward. But then on the flip side, you've got the market going up and down, tons of pressure to cut fees, and you never know when the regulators might change the rules.
So, with all that going on, what's the game plan? How is management going to steer the ship? Well, the analysis points to a clear 4-step strategy. They're going all in on digital. They're creating new and innovative products. They're pushing to expand their reach even more. And they're looking at ways to bring in money from outside of India.
Okay, so here we are, Section 5, the final verdict. We've looked at the patient's health, its strengths, the road ahead. What's the doctor's recommendation? What does Web Cornucopia conclude? Is this a healthy investment?
And this really is the million-dollar question for anyone thinking about investing, isn't it? We know it's a great company, but does being a great company automatically make it a buy right now at this price?
To get a feel for that, you have to compare it to the competition. So here, we're looking at the price-to-earnings ratio, the PE ratio. It's basically a quick way to see how expensive a stock is. And yeah, HDFC AMC's PE looks a bit pricey. It's got a premium. But the analysis makes a good point. You're paying for quality. Look at that return on equity, It's just in a different league than its peers.
Now, if we dig a little deeper with a valuation model, this is called a discounted cash flow analysis. It's a way to guess a company's value based on future cash. We get 3 possible outcomes. You've got your worst case, your best case, and your most likely base case. In that base case, it lands at around 4,250 rupees per share, which, interestingly, is pretty darn close to where the stock is trading today.
And all of this feeds into the final score from Web Cornucopia. It's broken down into these 5 areas. And you can see it scores off the charts on financial health and management. I mean, top marks. But the one thing holding it back, the thing that pulls the overall score down, is valuation. That's where it doesn't look quite as shiny.
So, what does that all boil down to? The final recommendation from this analysis is a hold. The thinking here is pretty straightforward. Yes, it's a fantastic company, but the market knows it. The price already reflects how good it is, so there might not be a lot of quick profit to be made for someone jumping in right now. So you might be asking, who should be interested in a stock like this? Well, the report suggests it's a solid choice for certain types of investors. We're talking about people with a long-term view, think 3 to 5 years out. It's for those who value steady dividend checks and the sleep-at-night stability of a market leader more than they're chasing explosive, risky growth.
And that really leaves us with one final big question to chew on. HDFC AMC is, without a doubt, the picture of financial health. But its price tag? It might already be factoring in that fantastic track record. So the most important question you have to ask yourself as an investor is this. Are you paying for the company's past performance? Or are you paying for its future growth? And that's a question worth thinking about.